Good day, fellow investors. Stanley Druckenmiller recently did one interview with a Norwegian bank and one on Bloomberg, and in this video, as Stanley is the best investor out there, I want to summarize the 1 hour interview and more into a few key topics that he shares. Before starting, let me just say that we do value investing here, trading not as Druckenmiller, but the basis of his investment style is also what we try to do here. And let's immediately start with Druckenmiller's view on the current market, and he looks at companies, company data, fundamental analysis as we do, and he does not see any material signs of weakness except housing market and other pockets. Therefore, no economic problem in the next 3 to 6 months. That is something good to know. However, he also thinks that financial conditions are very loose, and those have tightened considerably since the Fed cut, but still above normal and still very positive for the market. He has been obsessing about whether we are again in a period like the 70s where what is next is an inflationary spike. He is seeing inflation down but worried about it going forward, and for that we need to go back to the 70s when inflation was close to 6-7%. This is the average here on Fred. Thus, I think it reached 7-8% like it did 2 years ago. Then it went down to about 3% like it is now, and the Fed started easing, the recession was coming, and what happened with inflation? It spiked above to, I think, 12% was the first peak, then it went down again, and then again, until Volcker came and solved it for good. But this decade here was a terrible decade for investors. And he also mentions how the Fed is short-term focused, data-driven, as they say, but it's completely wrong. And when I said inflation, Fed, in Google, I didn't write Fred because I was looking for this chart from the Fed. This is what immediately came up as top stories. Data keeps Fed rate hopes intact. US inflation rose 2.6% in October, so vary of financial risks as they weigh more rate cuts. Yes, inflation is going down. 2023 was 4%. Will likely be between 2.5 and 3 for 2024. But Druckenmiller is worried that the Fed declared victory too early because they cut now 75 basis points, because his interviews were made before the last cut, with tight credit spreads, no sign of weakness, equities roaring, gold at all-time highs, Bitcoin going crazy, and what is the Fed doing is cutting rates. And you'll see how the market doesn't agree with the Fed. And inflation can turn up again because of the easing financial conditions that the Fed is now offering with cutting rates. Again, he said that if Trump wins, and that is what happened, there could be more animal spirits, deregulation, tariffs, inflation, immigration, labor, less immigration, higher costs, thus more inflation. And the Fed is obsessed with the soft landing, their own legacy, and their own forward guidance. So they are forward guidance dependent, not data dependent. With their forward guidance that they have to lower rates, the Fed eliminated its optionality, and according to Druckenmiller, the Fed's job is to avoid the big mistakes, not fine-tuning month by month as they are doing now. And this is the big risk also here. What if the Fed is wrong? Then everything changes, and the Fed is focused on this news, on the short-term data, and you can see that into their forward guidance, and they act like they have to do what they are projected no matter what is the actual situation. We have improving economies, we have unemployment rate extremely low, but the Fed said they will lower rates And as inflation is down for a little bit, but still above the 2% they want for the long term, they said they will cut rates, and that's exactly what they are doing, because their forward guidance says next year we have to be around 3%, and then lower long-term interest rates have to be between 2 and 3%. That's their forward guidance, and the market is disagreeing. From when the Fed cut rates in September, so the Fed cut rates down, the 10-year Treasury went up from 3.5 to 4.46. And since the last Fed cut of half a percentage point, the 10-year Treasury is going up. That means the market is not agreeing with lower interest rates. The market is not agreeing with long-term lower interest rates, and that is something that Druckenmiller says he prefers to trust the market rather than the Fed or academia. This is the key point of Druckenmiller's interview. And he says that the Fed is trapped by forward guidance, markets are better predictors than professors, and if inflation is above the target, there is just theory that the current monetary policy is restrictive. Equities are roaring, thus it is not restrictive. We have huge fiscal spending, and it doesn't make any sense at all to cut just to commit to that forward guidance. And the market has already reacted. We have fiscal expansion going on, so 7% deficits at full unemployment. That is what leads to the key risk that the Fed will be wrong. And let's say that the US Treasury goes to 7%, because Druckenmiller says that the 10-year Treasury should trade at nominal GDP, so we have 2% real GDP, 4% inflation, or 2.5% real GDP growth, 4% inflation. You're close to 7%. The current yield of the S&P 500 is 3. If this becomes the new normal, perhaps even higher, the S&P 500 goes down 50%, and that is what he called a nightmare for markets. But we'll discuss that more next week in a special video for the scenario in detail. But this is not relevant, as we discussed at the beginning, because there is no sign of weakness for the next 3 to 6 months. He also mentioned that for the budget deficits, but he describes it as going bust slowly, then suddenly. Debt to GDP cannot go up forever. There will be a reckoning, but he doesn't know when. Nobody knows when. For now, the reserve currency is doing US well, but running deficits with full employment can't last forever. And the first signs where this could be a problem is late 2025 or early 2026, when all the cheap debt that was taken 2020 to 2022, when interest rates were zero, starts to roll over. And the trigger could be a failed auction of US Treasuries and the Fed wrong about inflation, rising rates, and that not in line with forward guidance. When could that happen? Could be 6 months, could be 6 years. On the question how high can rates go, 6-7% would be something normal for him. That would crash the markets, and he says he's not predicting, just open-minded to it. And 25% of his net asset value is short bonds. He shorted them when the Fed started cutting, and that was an easy boom for him. On the stock market, for now, the light is yellow, not red, so you have time to see how the risk fits you personally. The AI boom will likely continue as the private sector sees it as an existential threat to their business. If the competitors investing in AI are right, you lose your business. That's why the prices are very high in the tech sector, but the P ratio 30 for him means growing at 25-30%, and he does not yet see that. The current trade for him is to be short bonds. He is still doing that. Of course, that's a little bit difficult for us investors, and he has been shorting them since here. So again, he made a great trade. But the key takeaway is that the markets are already disagreeing with the Fed, and this is something we will have to watch over the next year or two, as Druckenmiller says. Enjoy the full video if you have the time. If not, I hope you enjoyed this 10-minute summary.